Starbucks just released their quarterly results, and they are not good. Even their CEO said, "This quarter's results do not reflect the power of our brand, our capabilities, or the opportunities ahead." And he also added that this quarter did not meet their expectations. Well, no wonder. Sales declined by 4% and earnings per share declined by 14%. So, after publishing these results, Starbucks stock went down by around 15% in one day. So, it's not a pretty picture, but if we would make our investment decisions based only on the short-term results, we would not be investors, but just speculators. So, is it really that bad, or is it just a short-term problem, and as long-term investors, we can take advantage of the price drop and buy a great company at a bargain price? If you were to invest $1,000 into this company 10 years ago, you could buy around 28 shares. And now they would be worth something close to $2,097. And this company also pays dividends, so in that time you would get $406 as dividends. So if we add together both of those numbers, we get $2,503, and that is a gain of 150% in 10 years. That is a nice result, but of course the future can be a totally different story. So let's see what are professional investors and insiders thinking about this investment. Individual insiders, that is a check. 2.1% of the company is owned by individual insiders, and we like to see this number over 2%, so that is very nice. The management has its skin in the game, so they should take good care of the company. And are individual insiders buying? That is an X. In the last few quarters, we see a lot of sale transactions. And do super investors own this company? That is a check. 7 super investors own Starbucks shares, including people like David Katz, Thomas Geithner, and Lee Ainsley. So some very strong investors. And are they buying right now? That is a check. Looking at the data we have currently, we see that they are increasing the number of shares they own. So insiders are selling, super investors are buying. So that does not help us a lot because the trend is not clear. So let's take a closer look at the company itself. Return on invested capital, that is a check at 31.1% 10-year median returns. So that is a beautiful return. This shows that the management is doing a nice job. And what do we know about net profit margin? It is a check at 11.4%, and the industry median is just 3.7%. Starbucks margins are close to Chipotle Mexican Grill, which we analyzed recently, but they are nowhere near McDonald's, which has an absurd net income margin of 33.4%. That is crazy. And now let's take a look at share buyback. It is a check. In the last 10 years, the company bought back 24.6% of its shares. So that is creating real value for investors. If there are less shares on the market, every share we own is representing a bigger part of the company, and therefore it's worth more. And the debt? It is an X. It would take over 4 years to pay the long-term debt with a current free cash flow. And we want to see it under 2 years. So that is not ideal. It doesn't look crazy, but with higher interest rates, it is not a perfect situation. Revenue growth, that is an X at 9.2% 10-year compound annual growth rate. And we would like to see this number higher than 10%. So it is a decent growth, but nothing exceptional. And free cash flow growth, that is an X at 7.6% in the last 10 years. So free cash flow is growing even slower than revenue. And earnings per share growth, that is a check at 11%. And also here, we would like to see it higher than 10%. And the reason for a higher per share growth is the fact that they are buying back shares and creating value that way. The dividend yield is 3.1%, so shareholders will get $2.28 annually per every share. And the payout ratio, that is an X at 61.5%. And we want to see the payout ratio between 20 and 50%. So it's a bit high because it leaves only 38.5% of earnings in the company. But maybe they don't see that many growth possibilities, and that is why they don't need all that cash. And what about dividend growth? It is a check at 9.8% 5-year growth rate. And it is a very nice and steady growth. It looks like Starbucks is aiming to become a dividend aristocrat. They have a long way to go, but the trend is pretty obvious. Price to earnings ratio is 20.1, and that is even after the recent drop in price. So it is rather on the high side, but it is not a crazy multiple considering what we are currently seeing on the market. But to properly value Starbucks, we will use a discounted cash flow formula, and we will make 3 scenarios of its future growth. So in the low scenario, we will estimate a growth of 6% for the first 5 years and then 4%. In the medium, 8% and then 6%, and in the high scenario, 9% and then 8% growth. So the low scenario is around half of the recent growth of Starbucks, so we are anticipating a meaningful slowdown. Medium is a slightly slower growth than what we have seen in the last 10 years, and the high scenario is predicting the same growth we saw in the last years. So with such estimates, the intrinsic value in the low scenario is $40, in the medium $48, and in the high scenario $55. But we have to always apply a margin of safety to those prices. I use a 30% one. For some people it may seem too high, but I prefer to miss an opportunity rather than get myself into a lot of trouble. And with such a margin, we get in the low scenario $28, in the medium $34, and in the high one $38. And the current price is around $72. So it is all in the red. Even with a recent price drop, this company is expensive. So what are the positives? Individual insiders own over 2% of the company. Super investors are buying. The company has a very nice financial health, except for the debt, and a growing dividend. What are the negatives? Insiders are selling. Like I said before, substantial debt, single-digit growth, so not bad, but not exceptional. And finally, the price. My valuation went down by 30% since I last analyzed this company, and the stock also went down by 30% at that time. Reasons for a lower valuation are lower free cash flow, higher debt, and lower cash. But also, I do not believe that in the next few years Starbucks can grow faster than it did in the last 10 years. I'm sure it will grow, but I just don't see a reason for it to accelerate. But tell me in the comments what is your view on this company, and am I too conservative? If you like this video, you may want to see my analysis of Chipotle Mexican Grill or Monster Beverage. Thank you so much for watching, and see you in the next one.